Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Philip Morris's stock so we can determine if it's a buy or a sell. Philip Morris is a tobacco company with products sold in over 180 countries. Its most popular product is Marlboro. Before its spin-off in March 2008, Philip Morris was an operating company of Altria. Tobacco companies have been the target of intense litigation, and Philip Morris is probably the biggest target. The company is headquartered in Stamford, Connecticut, and was founded in 1847. That was when it was originally founded. The new spun-off entity has only been active since 2008. Let's get started with the model. This is a large cap company, 143 billion market cap. They're trading at $92 a share, and they have 1.6 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have a ton of free cash flow. For the amount of revenue they generate, they convert a lot to free cash flow. Over 9 billion in 2020, over 11 billion in 2021, 9.7 billion in 2022, and 7.6 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also really high each year, from 8.6 billion to almost 10 billion to 9.5 billion to 9.2 billion. Revenue is a sales for the company, and that steadily grows each year from 28.7 billion to a little over 32 billion. Here's their most recent income statement, the first quarter of 2023 versus the first quarter of 2022. The sales of their products, their cigarettes, is 19.3 billion. They pay a hefty excise tax, 11.3 billion, which gives them net revenue of 8 billion, a little higher than last year of 7.7 billion. Let's get a breakdown of this 8 billion so we know what it is. Of the 8 billion, 5.2 billion is from combustible. Combustible means you need to use a flame. So a traditional cigarette is combustible. Smoke-free, like chewing tobacco or vapes, that's 2.7 billion. And you can see their combustible revenue went down from last year, but smoke-free grew a lot from 2.4 billion to 2.7 billion. Revenue in Europe for traditional cigarettes is 1.8 billion. 2.2 billion in South and Southeast Asia, Commonwealth independent states, and Middle East and Africa. 700 million in East Asia, Australia, and Philip Morris duty-free regions. Revenue in Americas went up from 400 million to 430 million. Revenue of 136 million from their Swedish Match acquisition. For smoke-free products, revenue in Europe went down from 1.3 billion to 1.1 billion. That's mainly due to higher competition. 320 million in SSCA, CIS, and MEA. 830 million in EA, AU, PMIDF. America only 15 million. Really small part of their revenue. They need to grow that. And 445 million in Swedish Match. As of the end of last year, Philip Morris acquired 95% of the outstanding shares of Swedish Match. They acquired the shares through a tender offer and paid around $15 billion. It looks like they paid 14 billion of cash and assumed $500 million of debt. Swedish Match is a market leader in oral nicotine delivery with a big presence in the US. The acquisition will accelerate PMI's transformation to become a smoke-free company and a comprehensive global smoke-free portfolio with leadership positions in heat, not burn, and the fastest growing category of oral nicotine, with the potential for accelerated international expansion. Their cost of revenue is 3 billion, that's up a lot from last year. The main reason for the increase is payroll. It's getting more expensive to pay people. Their gross profit is 5 billion, down from 5.1 billion. Let's see if their gross margins improved or not. To calculate their gross margins, let's take their gross profit over their net revenues. Gross profit is 4981, net revenue is 8019, so 62%. That's a pretty nice gross profit. Let's look at it last year, 5138 over 7746. It was much stronger last year, 66%, because cost of sales is getting so much higher. Excise tax is a bit higher last year. Let's calculate the percent of excise tax. It's more than half of their revenue. Excise tax of 11,595, revenue 19,341. So 60% of their revenue goes to taxes. Then they have to pay income tax later on, so even more than 60%. Let's look at it this year. 11,299 over 19,318. 58%. It's a little lower. They just get crushed on taxes. They spent $2.3 billion in marketing, so their operating income is $2.7 billion, down a lot from last year. Let's look at their operating margins. Operating income of 2,731. So this year it's 34%, which are pretty good margins. And last year it's a lot higher at 43%. Their expenses have gone up a lot. They're spending more money in marketing, more on payroll. They spent $230 million of interest on their debt. Last year was $154 million. They spent $22 million in pension and employee benefits. So their EBIT, earnings before interest and taxes, is $2.5 billion, $428 million of taxes, a loss of $51 million from their investments in other companies, net earnings $2.1 billion. Let's look at their net margins. 2102, so it's 26% this year, 2465. Of course it's higher, 32% last year. Still pretty good net profit margins, 26%. Their earnings per share has declined from $1.50 to $1.28. Let's look at the operating section on their statement of cash flows. And the way you calculate operating cash flow, you start with your net income, $2.1 billion. Then you add or subtract the non-cash items on the income statement. We add back $300 million of depreciation. They pass through a $96 million deferred income tax benefit, so we have to minus that out. And there was a $100 million asset impairment on the income statement, so we have to add that back here. You might not see these exact numbers on the income statement. They're just blended in with other numbers. They have some really big negatives and changes in working capital. For accrued liabilities, they have a cash outflow of $2.7 billion. An accrued liability is when a company has incurred an expense but has not paid it yet. These may be legal expenses they incurred in the past, and now they're paying for them this quarter. So in their operating section, they had a cash outflow of $950 million, even though they reported an accounting profit of $2.1 billion. Let's go through all the slides on their first quarter 2023 earnings results. Better than expected Q1, on track for a strong year. 35% of their net revenues is smoke-free. They increased their market share and user growth in IQOS. That stands for I Quit Ordinary Smoking. They upped their pricing in combustibles. They had strong US ZYN performance. ZYN are those small white nicotine pouches. Net revenues up 3%. Net revenue per unit up 4%. Diluted EPS down 4.4%. And diluted EPS is $1.38. They shipped 144 billion regular cigarettes. That's just in the first quarter. It is down from 148 billion. They shipped out 27 billion heated tobacco units. That is up from last year of 25 billion. Oral nicotine is up a lot, from 158 million to 173 million, up 10%. Their goal is by 2025 to have at least half the company smoke-free. It was under 1% in 2015, over 3% in 2016, 13, 14, 19, 24, 30, 32. Now it's about 35%. So they are growing that segment each year. Their smoke-free revenue in 2022 was $10.2 billion. If you annualize the first quarter, that's $11.2 billion. So they should be pretty close to 50% by 2025. IQOS users is up to 26 million. That pretty much grows every single quarter as well. And over 70% of these people totally quit regular cigarettes. In Europe, the sale of heated tobacco units goes up every quarter. It was 8.9 billion, now it's 11.1 billion. Europe still has a lot of cities with heavy smokers. Vilnius in Lithuania improved 42% from the prior year. Budapest 35%, Athens 29%, Rome, Lisbon. Illuma sales continue to grow in Japan, from 8 billion up to 9 billion. Here's a picture of an Illuma for sale. Illuma Prime Heating without a blade, no cleaning is required, designed in Switzerland, developed by Philip Morris. The latest model takes the appeal of heat, not burned tobacco, to a new position with the new technology Smart Core induction system, maintaining the original IQOS technology that heats tobacco leaves directly from the inside. Low and middle income markets promising key city growth. Sofia, the capital of Bulgaria, has the biggest growth at 16%. Here's their slide on Zinn. This is a product from Swedish Match. They shipped 261 million cans of Zim in the trailing 12 months, and that seems to grow every single quarter. 141,000 US stores sell Zinn, and stores are selling more, 36 cans a week. That's up from prior quarters. Let's look at the capital structure. Negative 8.9 billion of equity. This means the liabilities on the balance sheet are $8.9 billion higher than the assets. Debt of 47 billion. So 0% equity, 100% debt. Net debt 44.7 billion. So they have about 2.5 billion of cash on their balance sheet. This is the equity section on their 331 balance sheet. You can see negative $8.9 billion of equity. Their retained earnings are 34 billion. They call it earnings reinvested in the business. This is the sum of all the company's prior net incomes minus the sum of the dividends they paid out. So you can see they're a profitable company. Why do they have negative equity? Because they bought back $36 billion of their own stock. When a company buys back its own common stock, the cash goes down on the balance sheet and the equity balance goes down. So they actually have 27 billion of equity, but the reason it's negative is because you have to minus out 35.8 billion from the repurchase of common stock. If you look at a company's balance sheet and they have negative retained earnings, that means they're losing money. They're not a profitable business. So in this case, I don't think it's a big problem they have negative equity because they're giving back to the shareholders. If they really needed the money, they can just reissue those shares. Or in the future, if they need money, they just don't have to buy back any stock. Boeing is similar, negative equity because they bought back so much common stock. And they have a WACC of 9%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 201 billion. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $181 billion. We divide that by 1.6 billion shares. And we get a calculated stock price of 117. They're trading at 92, so they're trading at a 21% discount. It's a buy according to the model. Simply Wall Street is higher than me. They're at 145. They say the stock is 36% undervalued. 10 analysts price this stock, and the average price target is 116. The low is 110, the high is 120. Another 18 analysts price this stock, and the average price target is 113. They say the stock is 23% undervalued. They pay a quarterly dividend that they raise each year. It was $1.14 in 2018, then $1.17, $1.20, $1.25. Now it's at $1.27. That's a yield of 5.5%, which is 104% of their free cash flow. So they do need to generate a little more free cash flow if they want to raise their dividend again. It is 86% of their net income. This is where the stock has been trading since it was spun off in 2008. The spin-off happened during the Great Recession, so the stock went down a lot the first year. It got as low as $15. That would have been a great time to buy it. If your cost basis was $15, your yield would be so high. It did get up to $130 in 2017. Then when COVID hit, it got down to about $65. It's up about 50% since that bottom. It was over $110 a year ago. But if you get the stock at a good point, sub $80, just wait. It may go up and down. It may go below your cost basis at some point, but just wait. Eventually it's going to go higher and higher. There are 13 companies in the same industry as Philip Morris, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx out of all the companies, $1.1 billion. We can't look at their debt to equity ratio since they have negative equity. Of all the companies that pay a dividend, they pay the second smallest. VTI is over 9%, Altria is over 8%. They generate lots of free cash flow, $7.6 billion. They're by far the largest company on this list. Their price multiples are worse than the median in every category, but not that much worse. They generate the second most revenue, a little behind BTI, and their 5-year annual revenue growth rate is 0%. If they can grow their revenue non-combustible, their revenue should be going up. That's why they acquired Swedish Match, and they're looking to acquire more companies. So to summarize, I have them trading at a 21% discount. The spun-off company has been around 15 years. The original company has been around well over 100 years. And they're just a cash cow like any tobacco company. Most people who own the stock don't really care where the stock goes as long as they get their dividend payment. That's why people buy stocks like this and certain other stocks for that dividend payment, that safety. And there's nothing wrong with that. I rank their free cash flows 4 out of 10, their revenue 7 out of 10, and their ratio is 4 to 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.